Welcome back to the Patrick Lane Show, where we talk about personal finance, investing in real estate. And today, what are we going to talk about? Of course, GameStop, and whether it's a good thing or a bad thing that Congress is still talking about GameStop and Robinhood and the prices from January until now. So before we get started, do me a favor, smash the like button right out of the gate. Hit the subscribe button, ring the notification bell. It really helps us to grow the channel, and we appreciate it a lot. So today was part 2 of the House Financial Services Committee hearing. You may recall back in February, they had part 1 of the hearing, and that was the one that got all the fanfare. That's the one that had Vlad from Robinhood. It had Ken Griffith from Citadel. It had Gabe Plotkin from Melvin Capital. It had all of the big players. That was the one that led the news for the hearing that day. Well, here's the problem. Once that was over, Congress kept churning behind the scenes, and they set up this part 2 hearing. Now, this is not to be confused with the Senate hearing that was last week, and we did a video talking about that you may want to check out as well. I will put the card for that one at the end of the video, so be sure to hang around and look at that one. But today, they simply doubled down again on wanting to restrict not short sellers, not hedge funds shorting more than 100% of a stock, not market manipulation by market makers or Robinhood, not Robinhood and other brokerages shutting off trading or only partially shutting off trading so retail investors could only sell and not buy. No, those things didn't, in Congress's view, in this committee's view, didn't have anything to do with price manipulation or price fluctuation for GameStop stock. What Congress today was focused on, and it was very apparent, the way to fix Robinhood shutting off investors' ability to trade is to stop payment for order flow, which, you know, maybe that's a good thing, maybe that's not, but we didn't really dig into that at all during the hearing today. Some sides said that it was good, some sides said that it was bad. Here's what I know. Payment for order flow results in free trading, zero commission trades for you and I as retail investors. So if you're old enough to have invested before Robinhood or before E-Trade or before TD Ameritrade, then you know that just to place a trade, if you were going to trade one share, you're going to buy one share of a stock, one share of GameStop when it was $20 back in January, you were going to pay $9.95 plus 2% to trade that stock, to buy that one share. So what happens? You don't buy the share, right? Because it's going to almost double your cost basis in that stock. Those of us out there who are retail traders and have Robinhood, WeBull, by the way, links in the description down below if you want free stocks, make sure you sign up using those links. But those of us who trade on WeBull, Robinhood, and other zero commission, zero fee trading apps are where we are paying zero fees because of payment for order flow and because they make their money in other ways rather than charging us a fee to manage the account or to trade. Now, maybe we should stop payment for order flow. That's what some countries have done. The UK, for example, has outlawed payment for order flow. When I looked at the UK and tried to find how many apps there were that were free, that were zero commissions, just like Robinhood and WeBull, I found one, and that was eToro, which is also in the United States. So I'm not sure that being able to trade commission-free is going to stick around and last beyond outlawing payment for order flow. Maybe it will, maybe it won't. But today, Congress and this banking committee was focused on payment for order flow. Again, oh, they're wearing me out. Again, with the gamification of Robinhood and gamification of WeBull and other trading platforms. And apparently, they think that it is inherently a bad thing if you enjoy trading. If you enjoy investing your hard-earned money into a stock that you like, then they think that is gamification and you shouldn't have fun investing for your future. So that's number 2 that we learned today. And the third thing that we learned today, financial transactions tax. So I don't know why they think that that is going to be the end all and be all, but raising money off people who are trying to just invest and get by. Now the argument is, oh, well, it's only going to affect people who trade a lot or who trade at high volumes. But the fact of the matter is, it's going to be collected on everybody. You and me, when we buy 1 share, we're going to have to pay that financial transactions fee. When we buy 10 shares, we're going to have to pay that financial transaction fee. When we buy a fraction of a share, we're going to have to pay that fee. And if you put together outlawing the payment for order flow, if you take away the incentive for people to use apps because they look good and they're easy to use, that's what they call gamification. And if you take away, or if you charge a fee on top of that because of the financial transaction tax, I think a lot fewer people are going to be engaged in investing and trading. Now, maybe, just maybe, that's the intended outcome, that they actually want fewer people in the retail trading space. But I tend to give people in Congress the benefit of the doubt. Maybe I shouldn't. But erring on the side of caution, I think this phenomenon goes back to one of the videos we did previously, which is GameStop gamers versus boomers. Now, in that video, we talked about how people now coming of age, investing, have grown up in the digital age. And so they're early adopters and they're quick adopters of digital currency, digital assets, cryptocurrency, all of these things. Well, a natural extension of that is the app on your phone to trade stocks and to invest. And if you notice on the committee, there's very few people who are of that age. And so most of the people, particularly the leadership of this committee, quite frankly, are boomers. And, you know, I was laughing while I was watching the video, and I couldn't help but think that it was, you know, the boomers and the Karens who think that you don't know anything, you're not sophisticated enough, you're not smart enough to invest your own money and know what you want to do with it. So they're going to just help you by completely outlawing the ways that you trade and invest right now. So it's a complete farce that they're on this committee or in the government are going to come and help you to invest and protect you. And that's just my take on how the hearing went today. Now, the interesting thing is that there were some of them who I think frankly are being malicious, and they came right out and said it. You know, the guy, Congressman Scott from, I think he was from Georgia, frankly came right out and said that he thinks that free speech in the form of Reddit should be outlawed. That we shouldn't be able to get on WallStreet Bets or other forums and talk about stocks that we like, the reasons that we like them, and the due diligence that we've done to bring us to the conclusion that we like a stock. So that is, to me, just an outlandish position for someone to take. Not only does it, you know, violate the First Amendment and restrict our freedom of speech, but it also does no good for the exact people that he pretends that he's trying to protect. You know, it's not going to do anyone any good to, instead of getting information for free that is peer-reviewed, that is ridiculed on social media, that is verified on social media, when comparing that to having to pay somebody and go into their office and get their advice for a stock that frankly they're making money off of when they sell you the stock. So I don't think that a lot of these boomers and Karens on this particular committee frankly understand the market, and frankly I don't think they understand where retail investors like us are coming from, what we want, what we have available to us at our fingertips in the way of information, and our ability to make choices for ourselves and determine our own investment future. So this is just a warning to anybody out there who's a retail investor. You should pay attention. If you've not been paying attention to what Congress is doing, not because it's a political issue, not because it is, you know, breaks down along party lines or it doesn't break down on party lines. I don't care about any of that. What I care about is this is a huge opportunity for retail investors to take control of our investment future for low cost, no cost, with all of the information available to us at our fingertips, and we can drive what happens to our own investments. And Congress are going to create all of these impediments, and they're going to drive us from 2021 to 1981 when it comes to the ability of retail investors like us to invest for ourselves. Do me a favor, leave down in the comments below whether you think that Congress messing around with trading is a good thing, whether they should get out of it and stay out of it, whether retail trading is good for the stock market, and whether these things that we've outlined are going to be good restrictions that they put into place or whether they're going to be bad restrictions that they put into place. I'd love to know your thoughts. Thanks for watching today. We really appreciate it. Do me a favor before we get out of here. Smash the like button, hit the subscribe button, ring the notification bell. The channel's growing and we really appreciate your help. And we'll see you in the next video.